Hello friends, this is Vijay Bambwani. I hope my video of last week helped you make some money. In this week's video, I want to talk to you about whether the market can resume its uptrend, what can trigger it, whether the market is shaky, whether the bulls have the strength or lack the strength to take the markets up, and how and where you should be deploying your money to trade through the week. Welcome, and let's jump right into the market roundup coming up on your screen. You can see that the Nifty basically relatively outperformed the Bank Nifty. In last week's video, the thumbnail which you can see on your screen, I had discussed that the Nifty was statistically much more stronger compared to the Bank Nifty. I had shown you the impetus chart and the basis, etc. And sure enough, the Bank Nifty fell faster and harder than the Nifty 50. The reasons are not really far to seek. You see, the US dollar came up again. That's detrimental to emerging markets because it triggers imported inflation. Crude oil and natural gas jumped again. Both these commodities are inflationary and they trigger price rise. The rupee fell 0.5% versus the US dollar, which again is a negative indicator. And the 10-year benchmark bond yield also rose 0.5%. What you are basically seeing is a mild decline in the NSE market capitalization, which is a minor mercy because things could have gotten a little more bearish, but they didn't because the overseas market cues were positive. The Dow Jones basically just managed to hang on to some gains. The Nasdaq and the S&P 500 did relatively better. On your screen now is the daily chart of the MWPL, the market-wide position limits. What you are seeing is a continuous rise in the open interest of traders, which is along routine lines. And this continues till the third week of the derivative series. Now, as you head closer to expiry, which is maybe Monday or Tuesday of the expiry week, things peak out and MWPL starts plateauing or even falling thereafter. So, as you can see on the weekly chart, MWPL seldom rises beyond the third week. And in this case, what we are seeing is 4 consecutive weeks of a rise. But you're not getting the complete picture here. Only the daily chart could have given you the complete picture that up to November, we used to see MWPL peak out between 32 and 34%. But come December and Jan, we haven't even seen a crossover of 30% on a weekly closing. So the 1 Marshmallow and the 2 Marshmallow guys, the theory which I have explained in this video, the hyperlink to this video will be in the description below the video itself. The 1 and 2 Marshmallow guys are showing caution. Now, let's see the index and stock futures turnover. This is cumulative derivative series of 3 months, that is March, April and May. What you are seeing is index futures saw a marginal decline in turnover, whereas the individual stock futures saw a week-on-week pickup in turnover. Now, this is trading participation increasing in individual stocks. So, a stock-specific activity was seen, which explains to you why the headline indices, especially the Nifty, was relatively range-bound. The weekly chart of the same stock and index futures turnover tells you that the index turnover has been in decline since the last 4 weeks, whereas the last fortnight has seen stock-specific activity gain precedence and traders are willing to take the risk of higher volatility in individual stocks rather than trade the headline indices. Let's now go to the Bank Nifty and Nifty prompt month futures on a daily chart here. And last week, I told you one of the reasons why the Bank Nifty would be weaker than the Nifty 50 was the basis. And what you are seeing is in the last 2 trading sessions, of the week gone by, the Bank Nifty really saw an expansion in basis. Now, this is explained by very sharp short covering by the bears because they were taken by surprise. So far, what they were doing was they were shorting the Bank Nifty and things were going their way. They were getting mark-to-market profits. They were rolling over their short positions from day 1 to day 2, and therefore there was a sense of complacency. The Bank Nifty surprised them with a pullback from lower levels, and they were forced to cover their shorts. Besides, closer you get to expiry, people do tend to wind down their positions, both long and short. Nifty basis has been buoyant since the last 3 or 4 weeks. As we will progress and see the weekly chart, which is on your screen now. See how the Nifty basis, which is showing as a blue line on your screen, is sloping up persistently since about a month and a half. The Bank Nifty basis, on the other hand, has simply skyrocketed in the week gone by. Can this basis be sustainable? In my humble opinion, this kind of a skyrocketing basis cannot be sustained and things will have to cool down. Do remember, this is the expiry week coming up and you're going to have weekly and monthly expiries, which means the basis will have to contract. So this is a one-off volatility spike, which I have been telling you in on my social media accounts. If you do care to connect with me, the contact coordinates of mine will come towards the fag end of this video. I put up a lot of cool stuff on my social media account, so do take the effort of connecting with me there. Now, on your screen is the advanced decline ratio on a daily basis. Note how the advanced decline ratio stayed below 1 all throughout the week. On all 5 days of the week, the bulls could not even match the bears. If it was 1:1, that means for every gainer, there is a commensurate loser. But here, the losers were far more. So the one Marshmallow guys were clearly on the back foot. They lacked the firepower to go out there and buy aggressively. And the daily chart, therefore, is sloping downwards. Let's take a look at the weekly chart. What you are basically seeing is that the week-on-week advanced decline ratio has simply collapsed. We are now at 0.50 and previous week it was 1.77. So what we are seeing is that the advanced decline ratio is at the lower end of the 20-week range. The 5.31 peak, of course, should be treated as an aberration. But let's just say 2.2 or 2.5 could be the peak and 0.25 could be the trough, the bottom. We are at 0.50, which is towards the lower end of the range, which means the average retail trader is not really buying in very large numbers, and that's for sure. So what's taking the market up? As I had told you in my previous week's video also, when the March end comes in, from the Indian traders' perspective, March ending is not just any routine quarter. It is a financial year end. And the mutual fund industry, the big boys, are basically interested in propping up their net asset values, their NAVs. So they buy progressively and bid prices higher. So the rally in the market in the last week of March can be attributed to the institutional buyers primarily, which is what is showing in the negative advanced decline ratio. Now let's take a look at the impetus chart. This is something that you've loved, you've trusted, you've traded on over the last 6 months. And what we are seeing is a precipitous decline, a very sharp decline on the daily impetus chart in both the Nifty 50 and the Bank Nifty. Why did this happen, my friends? This happened because last week, what you saw was range-bound trading in both the indices, and traders did not really get too much of intraday price mobility to expand their positions, which is why the impetus fell. Does it mean that the market will fall? I'm not saying that. Impetus basically tells you the force. So when the market is range-bound, obviously it is lacking force. What can follow from here? This is something that we discussed 3 or 4 weeks ago. I told you that when the impetus falls very, very sharply, it's like coiling a spring and compressing it. As soon as you let go of the pressure, the spring recoils and bounces back. So this volatility can jump anytime and take you by surprise, which is something that I want my friends to be very, very careful about. Let's take a look at the weekly chart of the bank and Bank Nifty and the Nifty 50 impetus. What you're basically seeing is a confirmation of the daily chart, but this gives you a longer term perspective. The impetus has simply fallen off a cliff and you're now at a month and a half low of both the indices where the impetus is concerned. Now this is worrying. Why is it worrying? Because when the impetus is this low, a little bit of buying or a little bit of selling can make the price move in very large magnitudes, which means your stop losses can get hit and the price moves can be extremely vicious. So please, friends, let's be careful out there. Now, let's take a look at our freshly launched LWTD indicator, which you have been banking on since the last 3 weeks. This is the daily LWTD or the lift, weight, thrust, drag index. And what you are basically seeing is that the Nifty has remained in the negative zone where percentage gain or loss is concerned in the last 3 consecutive sessions, Wednesday, Thursday, and Friday last week. But the LWTD is remaining above positive, which means at lower levels, you will see buying support coming in. But do note, my friends, the LWTD itself is sloping down, which means the buying momentum which will come at lower levels will not be as strong as it would have been if the LWTD was above zero but rising higher. Here, the slope is downwards. So, sure enough, lower levels may see price support coming in. Do remember, institutions come and support the markets in 31st March. And this is what the LWTD daily chart is reflecting. Let's now go to the weekly chart of LWTD. What you are seeing is wild gyrations in the Nifty gain and loss percent. But week on week basis, the Nifty's gain loss reading is below zero, whereas LWTD has gone above zero. So statistically speaking, will the markets rise or will the rally resume? That is what the thumbnail of this video was. Statistically speaking, I would say that the institutional players will attempt to push the markets higher if and when they fall. And if there's not much negative news coming in from the Saudi Arabia front, you have been, if you have connected with me on social media, on 9th of January, I put out news on Twitter that the Saudis might have retaliatory airstrikes against the port towns of Hodeidah and Salif, because that's where the Houthi rebels are firing missiles and launching drones on Saudi and UAE oil installations. And you have seen oil distribution infrastructure at Jeddah in Saudi Arabia being damaged by the Houthi attacks. So if at all this front escalates, it could worry the markets. But so far, we are talking statistics and we don't know whether this war will escalate or even if it leads to a war in the first place. So do keep your ears to the ground. As things stand right now, the data that we have right now, it looks like the market will get support at lower levels. Friends, I now go to the 4 categories of traders and their footprints here. I start with the FIIs or foreign investment institutions who've reduced their individual stock futures net longs from 3,74,000 odd lots to 3,26,000 lots. Where their index futures are concerned, there too they have reduced their net long positions, as you can see on your screen. But do remember that institutions normally tend to have a hedged exposure in futures. Now going to the DIIs, the domestic investment institutions, what they have done is cut short their individual net short positions, individual stock net short positions marginally. From 15,81,000 lots, they are now short at 15,61,000 lots odd something. Where their index futures short positions are concerned, they've only risen from 38,000 lots net short. They are now at 50,000 lots net short. Now for the two very interesting type of market participants. Number one, the prop traders. Now these are brokers' own proprietary trades. They are next best thing to insiders, because these brokers know who's buying and selling, and therefore their trades reflect what the specialist expectation is all about. What you are seeing is that the prop traders are actually cutting their net long futures position in individual stocks. From 89,000 odd lots, they are now to 83,000 odd lots net long in individual stocks. But they've cut their net index short positions from 15,000 odd lots to 4,000 odd lots. So I'm concerned about the fact that the proprietary traders, the brokers, the sharp and smart money is reducing its long positions. Now for the final act of the retail traders. These guys have been doing all the heavy lifting and all the buying, and let's see what they have done. The retail guys have expanded their net long positions in individual stock futures from 11,17,000 odd to 11,51,000 odd lots. Where their index futures net long positions are concerned, those have also risen from 27,000 odd lots to 43,000 odd lots. So the retail guys are actually feeling confident, whereas the proprietary guys are not so gung-ho. Friends, the indicators done. I now move to the bond yields, and this is a very critical aspect of the market, because this is the money supply to all other asset classes. Bond yields rising last week is not a good sign, which means that bond prices fell. Now, when bond prices fall, the specialists and the big money is basically telling you, hey, we are expecting inflation to go higher and possibly interest rates to rise in the coming future, which means other markets, other asset classes will feel downward pressure. As you can see on your screen now, the 10-year benchmark bond yield with the two moving averages, the bond yield is actually at the upper end of the 6-month range that we are mapping in this chart. We would ideally want bond yields to either remain constant or fall. Now, this has an adverse effect on Bank Nifty. I have explained to you countless number of times why, and this is a very neglected segment that the market does not pay attention to, which is very unfortunate. Now, you see, when bond yields rise, that means bond prices have fallen. The biggest holders of these bonds are banks. They suffer a mark-to-market loss on their bond portfolios, and their stock prices take a hit. So if you are a Bank Nifty trader, please pay particular attention to the 10-year benchmark bond yield. And keep your ears to the ground. These are data points that I update on my social media account every day. So do connect with me. My contact coordinates will come at the fag end of this video. Friends, the bond market's done. I now move to the US dollar index, or the Dixie as it is called. As you can see on your daily chart, it's risen on all 5 days out of 5 trading sessions last week. The price is comfortably above its 25-day exponential moving average, which is a proxy for 1 month holding on cost of an average bull. And as long as the price remains above its 25 DMA, the bull is incentivized and excited about holding on to their long positions. Note how the 9-month-old bullish trend line is also holding firm, and what we are seeing is a semblance of support emerging at 97.5 levels, give or take some. Moving on to the weekly chart, what we are seeing, the first thing that strikes you is that last week's bullish candle has pierced the prior week's bearish candle more than 50% of the body, and that is called a bullish piercing pattern. Now, if there is follow-on buying support coming in from the bulls, the US dollar index can actually rise, which is a negative thing for emerging markets, including India, because the USD INR will rise and it will trigger imported inflation. Everything that we import, including oil, gas, electronics, everything else, will become more expensive and cause hardship to the citizens. The price is holding on above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. That means the medium-term outlook also remains comfortable and optimistic for now. Friends, last week I advocated an expected range between 99.60 on the upside and 96.90 on the downside, which held perfectly well. In the coming weeks, I expect a range of 100.10 on the upside and 97.55 on the downside. Do keep a guarded eye on the US dollar index because all the other asset class prices will depend on this. Friends, I now go to the Bank Nifty, and this was very clearly on the ropes. It was under pressure, no denying that. And what you can see on the daily chart on your screen is that it fell on 4 out of 5 trading sessions, and it's fallen again below its 25-day exponential moving average, which is a month-long holding on cost of a bull, which means the guy who's holding long positions and rolling forward his long exposure is not even able to get his cost of carry, and mark-to-market losses are separate. So the first thing that the bull must see is the price going above its 25-day exponential moving average, and the exponential moving average itself should be rising. If that doesn't happen, hey, the bulls are in trouble, which is why the Bank Nifty is basically likely to remain under pressure. Going on to the weekly chart, what you are seeing is that the large bearish candle has pierced the prior week's bullish candle, and this time I would call it a bearish piercing pattern. And do note, where has the red candle come from? It's tested the 25-week exponential moving average, which is a 6-month holding on cost of a bull, and then fallen. So you see the price attempted to go towards the 6-month holding on cost, failed, and pierced the prior week's bullish candle, which is a red flag for the Bank Nifty. Should follow-on selling pressure come in, you could see the Bank Nifty underperforming the Nifty 50 again. Now that is not really very good news for Bank Nifty traders, especially who have a bullish kind of bias. If you are a nimble-footed trader who doesn't really care about which way you're trading as long as the profits are coming in, do note the ground is even Steven for you. Now, last week, the Bank Nifty was on number 2 of the most volatile list on the NSE derivative segment. And this week also, it was at number 2. It remained unchanged. So, the volatility is high. Being at number 2 for an index is not really very welcome. That's too high a volatility to handle for a retail trader, but at least it remained constant. And in the week gone by, I had advocated a range between 38,350 on the upside and 34,500 on the downside, which held perfectly well. I must admit, it wasn't because of any significant intelligence on my part, but because, relatively speaking, the market's ranges were narrow. So the parameters on the the support and resistance held. In the coming week, I expect a range between 37,325 on the upside and 33,500 on the downside. So Let's be careful out there, friends, because the Bank Nifty is really likely to be more volatile than normal. Friends, the Bank Nifty done. I now go to the Nifty 50, which basically outperformed the Bank Nifty and fell less. But exactly like the Bank Nifty itself, the Nifty also fell on 4 out of 5 trading sessions, as you can see on the daily chart on your screen. Mercifully though, the price still remains above its 25-day exponential moving average, which is a month-long holding on cost of a bull. So between the bulls who are holding long positions in Bank Nifty and Nifty 50, it is the guys who are holding Nifty 50 long positions who are losing less. And therefore, relatively speaking, they are in less pain. But that does not mean that the worst is over. For the Nifty to actually start bringing cheer and smile to the bulls' faces, it must trade above the round number of 17,400, if not 17,450. That would be welcome news. Let's turn to the weekly chart and see what's happening out there. What we are seeing is a small, tiny red candle forming after the prior week's big bullish candle. Now, this is somewhat of a consolidation. But at least it's not piercing the previous bullish candle like the Bank Nifty was. So it's not a bearish piercing candle. It could be a small respite. Nevertheless, one does have to keep a strict eye on the round number of 17,000. If 17,000 is violated, it could lead to a lot of pressure for the bulls because A, it's an expiry week, and B, mark to market is something that they will have to pay along with paying rollover costs to basically carry over their trades from March to April. Volatility, of course, remains high. And in the week before last, this index was at number 8. Last week, it went up one notch to go to number 9. But it's not to say that volatility has eased. It's just that individual stock futures volatility has risen. The Nifty also remains volatile, and the Jensen's measure and Trenor ratio still remain not in favor. I'm not saying hostile. All I'm saying is not in favor of aggressive, fresh, long leverage positions. So let's be careful out there because statistical beta or pure price volatility. Now, this is a metric again that I update on my social media accounts every single day. So do connect with me, please, and update yourself in real time. So a statistical beta will remain high, which will be a challenge, and volumes might remain low. So a little bit of buying or selling can switch the prices, kick them about in an exaggerated fashion. The only protection that you can have in a circumstance like this is to cut back on exposure, right? Friends, now the index section done. I come to the most popular segment of this video, wherein I give you 5 stocks which are high beta, high impetus, where you take small exposure, wait for large price moves to make your money, and 5 stocks which are low beta, low impetus, where you take big exposure but make money on small price moves. Why the difference? Because different traders, different mindsets, and therefore different techniques. So the high beta, high impetus list, where you take small exposure and wait for large price moves, is concerned. The list is led by Z at number 1. Number 2, Biocon. Number 3, Dr. Reddy's. Number 4, MFSL. Number 5, Abbott India. Do note, 3 out of 5 are pharma stocks. The low beta, low impetus stocks, where you take large exposure and wait for small price moves, is led by Exide at number 1, IRCTC at number 2, number 3, Bank of Baroda, number 4, Dr. Lal's Path Labs, and number 5, Colgate. Friends, this hierarchy of names can change from day to day because volatility compresses and expands on a daily basis. So what do? Please stay in touch with me because these are aspects which I update for my friends on my social media accounts every single day. My contact coordinates will come immediately after this video itself. Friends, I hope this video is going to add value to your trading in the coming week. And before I sign off from this video, I request you to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh content being put up out here. In the comment section, do let me know what you think of my work. Any feedback is always welcome. And please help me reach out to fellow like-minded, rational-minded, data-driven traders by referring my video to your family and friends. Also, below the video in the description is a hyperlink to my a playlist on Equity Masters YouTube channel. Do subscribe to that channel wherein I put up a couple of ideas every week and also avail of a free PDF trading guide from them. Friends, I thank you for your patience in watching my video till we meet again in my next. This is Vijay Bambani signing off for now. Do stay connected with me. Take care. Bye-bye. Have a very, very profitable week ahead. Thank you.